Okay, I've got 8:30. I think we've got everybody here that's gonna be here. Paul can't make it, Leland is sick, and Rowena is in court, so they will not be here. The first order is to approve the minutes of our November meeting. So moved. Second, any discussion? All those in favor?
Aye.
Thank you. And over to Janet.
All right, thank you. Good morning, everyone.
Good morning.
For our pension payroll status report for December, our pension gross payroll for the town, which includes the police and the Board of Ed, we have 99 retirees. The gross payroll was $159,960. No changes except the usual December insurance waivers for 2 retirees who are under 65 years of age and are waiving health insurance. We have 1 QDRO spouse for a total of 100 participants. For our fire department, we have 36 retirees, gross payroll of $15,739. No changes from November. We also have a QDRO for 37 total participants. January gross payroll was basically the same as December without the health insurance waiver. So there were 99 retirees. The gross payroll was $158,960 with 1 QDRO for 100 participants. The fire department, there was an additional firefighter retiree, Michael Larry. Well, you guys can handle that. Yeah,
It's a nice name.
yeah, I should have asked him when he came in to sign his paperwork, how to pronounce it. So now the gross payroll is $16,187, with the additional QDRO, we have 38 total participants. For our pending retirements, Craig Stone from the Board of Ed, he did retire last month. He completed his paperwork just last week, and so he will be added to the February 1st pension payroll and will receive both his January and February benefits at that time. Past Chief Brian Scow has applied for early retirement effective June 1st, and he has 28 years of service. For our current defined benefit and defined contribution plan for active employees as of January 17th payroll. For the defined benefit pension plan, we have 45 contributing town employees, plus we have 2 new police trainees who will start contributing at 6 months. And we have 20 contributing Board of Ed employees. For the defined contribution plan, we have 43 town employees and 29 Board of Ed employees. 75% of those defined contribution participants are electing the additional employer match.
That number is still going down, it looks like.
It does.
75%. So.
It is going down. I did a little split for the town is actually at 86% and the Board of Ed is at 59%.
Is it new people coming in that just haven't decided to sign up yet?
Yeah.
Probably,
Yeah, okay,
Gotta give them some time.
yes. Okay, other questions, comments, Janet? Okay, thank you very much. Investment advisors.
Great, thank you. Happy New Year, everyone. We'll put the perspectives. I think the best place to start is on page 4. Yes, yep. So a lot of changes going on, obviously, in the world. A lot of changes going on with rates right now. A lot of proposed initiatives under the new administration, but I think one of the things that I think has been sort of a drag on the portfolio is obviously the underperformance that we've had, especially in large cap stocks. I think we're going to address that later on the IPS, but I just want to kind of break down to give you a sense of what's driving this absolute return. All right, so if you look on the left hand side, total return since 1990 has been 12.1%. 7.1% of that is earnings growth. 2.3 has been reinvested dividends, and 2.7 is valuation, an increase in the valuation, right? So that's like the average that we've had over the past, 35 years. When we look at what happened in the last 2 years, okay, earnings growth has been much less than normal. The yields have been way less, about half than what they normally are. But multiple expansion has contributed to basically 20 of the 25% total return. So this is literally just people paying more for less earnings and less income, okay? And that to us is not a long-term sustainable, I'd say, strategy for stocks going forward. In fact, there's a study that Bank of America put out, it was about a month or two ago. And it basically looks at a linear regression of what you pay in terms of valuations, price to earnings ratio, versus your forward next 10-year returns. And the lower valuations you pay, higher next year returns, higher valuations you pay, lower forward returns. And it's pretty tight to the line. So everyone's expecting earnings growth to be spectacular as we move forward here. And that's one of the reasons the last 2 years has been, I'd say, abnormally good. But history would tell us this is going to have to be a seriously abnormal event for stock market returns to do well as we move forward. If you want to go to page 7. Bond yields, we talked about this, for the past, 4 or 5 years, right? We were in a bond bull market basically until 2020, and then bond yields obviously have started to rise. There's been a lot of talk with the committee on, increasing duration, and we've done that very, I'd say, modestly over the past few years. The volatility in the 10-year treasury is still, out of this world. I don't even know what else to say. It's like higher than a small cap stock. All right. We went from basically, again, at the end of 2023, 5% yield on a 10-year treasury down to 3.8. And we went all the way back almost to 4.8% just a few weeks ago. And now we're basically at 4.5, 4.6%. So the bond market is still telling you that the Fed is going to have rates higher as we move forward here. That's what the bond market's telling you. So the stock market, as I've shown you, it's not on this page right here or this presentation, but I've showed you the Fed funds expectations of what the market was expecting the Federal Reserve to cut rates, right? How many rates are priced in the next 12 months, and going into 2024 or 2023, it was 8, and then it went all the way back down to 2, and then going into 24, it was back up to 8, and then it went all the way back up to 2, and then literally in the fall of last year, it was at 6, okay, just a few months ago, and now it's down to 1. So the stock market really wants the Fed to cut rates. It's like, please cut rates. Like, that's what we want, and that's one of the reasons that valuations have gone up, is in anticipation of the Fed possibly cutting rates. But the other side of the coin is that the Fed knows that employment is still strong, the economy is still chugging along, and inflation, while it's ticking up a teeny bit, it's come down a ton from where it was before, right? So if they start aggressively cutting rates without a recession that is forcing them to do that, that's going to be inflationary. It's going to undo all the work that they've done. So that's why they've been very, I'd say, thoughtful and modest of 50 basis points, 25 basis points, 25 basis points. Our expectation is another 25 basis points in July, and that's it. So, yeah, data dependent, but stock market is saying, like, begging for rate cuts, and the bond market's telling you that's not going to happen.
Kevin, what is the book yield done on our bonds over the last 3 years? Like, how is it? Do you have any information on that?
I don't have that right now. We can look at the, Yeah, we can look at the yield to maturity on the pension portfolio. So we can kind of see like what the increase in duration's done, but basically we've been at like 4.75% to 5% over the last, I'd say at least 2 years. And before that, we were certainly, sub 2, sub 3.
And we
or
have
something like
a
that.
lot in shorter term
Shorter term, yeah,
and
still.
less in longer term, so there's no harvesting of losses to be done or anything like
Well, we
that.
don't have to worry about anything like that, because, one, you're a tax exempt entity, so we don't have to worry about, but if there was like a bond that, let's just say, had a loss.
I'm not even saying harvesting for loss purposes, harvesting to,
Like a bond swap. or
yeah,
something,
like
like a better,
basically, your return on investment will like exceed your losses within 8 months or 12 months. or
yeah. So the managers are looking to do that. I'd say our intermediate maturity manager is looking to do that more so than the short-term one. The short-term one is a bond ladder, so we're holding all
something. You
those
only
to
do it
maturity.
a longer term.
But the intermediate maturity manager, which is still less duration than the Barclays aggregate index, would look to do that. So let's just say they bought a 5-year bond, okay, and then rates went up. And new 5-year bonds were yielding, much higher than what the yield to maturity would have been on the bond that has a loss. Then they would do a bond swap, basically, to get into a better bond for the longer term. So that's what the active managers are doing.
Okay,
And one of the reasons we want to be active is because of the volatility that's going on in the fixed income portion of the market right now. Because when volatility presents itself, there's opportunity. Okay.
the long and short of it is, this is a good thing for income, for a portfolio that pays out.
It's a spending portfolio.
Yeah.
Correct. And as we've seen over the last few years, I mean, the income has
We
really
can make money on our money.
increased. It's gone from, I think, 450 to basically almost $700,000 over the last, I'd say 4 or 5 years. It's pretty substantial. So, if you want to go to page 8. All right, so this is basically looking at historical average returns in stocks and bonds, basically post World War II. It doesn't take into account Great Depression, things like that, but basically stocks have, averaged 11% since 1946, and bonds have averaged about 5%. Our anticipation going forward is that stocks and bonds are going to be a little more equal. So it's going to be a little harder to get, return out of stocks as we've had before. So this is one of the reasons we've been moving a little bit more money towards bonds. One is the income part that Carl just kind of talked about. Another is, again, just the PE that you're paying, and then that regression line that I talked about. We just think that it's going to be really harder to make money in stocks as we move forward, given where the valuations are. Go to page 10. This is really interesting because we've talked a lot about, has the diversification of having bonds or emerging markets, international, helped the portfolio. We did a lot of asset allocation studies that showed the volatility of the portfolio actually was decreased when we added these asset classes. This is sort of like another, I'd say, data point that shows the comparison of cumulative return over the last 25 years. If we looked at a stock-only portfolio, okay, on the left-hand side, I started with $100,000, by the end of 2024, we're at 486. If you had a more diversified portfolio with more fixed income, more international, more EM, you actually would have made more money. Goes against conventional wisdom because we've seen large cap stocks have just done spectacularly over the last, 15 years especially. But certainly, not from 2000 to 2003, and not in 2022 either. So diversification does help. It adds to total return and it reduces volatility in a bad market. Page 11. This goes back to some of our worries and the concentration of the S&P 500 right now. Usually when the market's is concentrated, it doesn't bode well for, again, the stock or the indices going forward. Anytime that a index gets, or a part of the index gets over to one economic sector gets over 30%, that's usually sort of the danger side. We've been over 30% of the technology for at least 2 years now. But you can see that the 10 largest stocks account for 37% of the weight in the S&P 500. The 20 is 47% of the weight in the S&P 500. So if you buy the S&P 500, you are not being technically diversified. You're actually concentrated because you're really just in, the 20 largest stocks. And then if you look at the valuations, this is kind of what we talked about before, which is 10 largest stocks are trading at nearly 39 times earnings. The 20 largest stocks at 33, and then the bottom 400 at 22.4, which is more sort of in line with, I'd say, historical norms. But even still, then a little bit rich. And then we've talked about AI and the Magnificent Seven. One of the things that's changed with them as well, and you've seen a little bit of change in leadership at the beginning of this year. Okay, value stocks are actually doing a lot better. Small cap stocks are doing better, things of that nature. There's a little more breadth in the market right now. The Magnificent Seven, the last 2 years, their earnings growth expectations were 40% year over year. Okay, that has now been cut down to below 20%. So what that really means is that the expectation at a minimum would be that your forward return should be about half of what they were in the past, given the earnings growth. So again, just sort of like another data.
And how do you reconcile that though with the fact that they're still doing so crazy?
Well, NVIDIA's actually kind of like held in here. It hasn't really gone in. That hasn't really increased. It's gone a lot of bouncing around, I'd say. It really hasn't gone anywhere for the last few months. Oracle's up 15% because Trump has given his buddy some money to deal with the infrastructure build on Starlink and some of the chips that they're going to help with. So I think it's just different parts of the market are finally starting to participate. Is really what it is. And if you look at one of the things I do want to just to highlight, the change that has sort of let's pass that down. So this is as of 2 days ago.
Oh,
And you can see that the change in leadership here is our return for the month, just in the first 3 weeks here, we're up 2.18% versus the benchmark and the 60-40 basically at 128. So there's been a change in leadership in terms of the types of stocks that we have in the portfolio are finally starting to get rewarded, I'd say, because they've been growing as well. They just haven't been growing as fast as these technology companies. So a good start to the year. And even yesterday, I think we had another 30 basis points. So for the fiscal year as of yesterday, we're up at like basically 6.1% for the fiscal year. So we're targeting getting to that, assumed rate of return, even in a, pretty tough month of December. And then again, changing leadership for this month. Any questions? So in terms of, what our thoughts are, you're going to hear the same thing. Is we want to focus on quality. We want to focus on stocks that are trading, at below average price earnings ratios, and we want to focus on investment grade short duration fixed income that's going to give us, more income from the portfolio. So we can deal with the spending. Any thoughts? If you want to go to page 4 after the town performance report, you can see for the fiscal year as of year end, we're only at 359 net of fees versus the IPS benchmark of 470. Basically, we're at a 60-40 portfolio right now. And again, I kind of talked about this, the income that we've seen, over the last year or the projected for the next 12 months, lower right-hand side is at just under $700,000. You're basically at an all-time high in terms of the pension fund balance. It's actually, just over $29 million as of yesterday. One thing I want to kind of point out, if you turn to page 6 of the right-hand side. Okay, so this looks at, over the past, around like, 20 years, what has the worst month, worst 3 months, worst 12 months, and then the max drawdown that we've seen over a period been for the portfolio and for the IPS benchmark, okay? And as you can see, the portfolio is protecting better to the downside when we have these periods of stress in the market, right? So that's part of what we want to do is make sure that when there's these shocks to the system, that we're diversified enough. And this is going back when we were much more heavily weighted in stocks too. So let's keep that in mind as well. So our thought would be that if there's another shock to the system in terms of the stock market, the bonds would actually do a little bit more, hold a little bit more weight and protect a little bit better to the downside than we've seen in the past. Any thoughts about that?
That's key, I think.
If you want to turn to page 11, we can see sort of like our overweights and underweights, underweight cash relative to the target. We'll talk about changing that with the IPS discussion. Underweight large cap, again, that's another one we're going to change, but we've added about 1% to that. And then we're now underweight emerging markets, overweight short-term bonds, still underweight investment grade bonds, and underweight high yield. So page 13, actually page 12 too is kind of interesting because one of the things that I think people were really concerned about was Trump's tariffs, right? It looks like he's going to start with, so starting with China, he's going to start with Canada and Mexico. So go figure. But when we look at how has the last quarter been in the different different asset classes, I just want to point out here, like emerging markets are down just slightly over US equities, and certainly less than small caps and mid caps over the last quarter. So one of the things that is a concern, I think, on a kind of like a higher level is he's going to go after China, even more so than we've already done. That's going to be a problem for emerging markets. Well, the emerging market index has really diversified away from China over the last, I'd say, 3-ish years. There's a lot of the stuff that's going internally with China, the real estate problem, the growth problem that they have, the debt that's especially in the real estate sector. So it's much more diversified as an index as it used to be. And we are using active managers anyways. So the threat of a higher China tariff is not going to have as big as an impact on the pension portfolio's emerging market exposure as it would for a China only manager, let's just say. And to kind of highlight that, if you go to page 14, and we look at the year-to-date numbers, okay, it's sort of like in the middle of the top column in terms of the performance, middle of the right, just says year-to-date 12/13/23 to 12/13/24. You can see, S&P 500 is up 25, Aristotle Value didn't keep up with the value index. Kane Anderson, has had a tougher time, but again, we just started with them like a few months ago. Okay, Siegel, Bryant, and Hamill, Schroders International, and Lazard, all three of those are basically 2x their index over the last year. Okay, these are the 3 most volatile asset classes we have in the portfolio. So the fact that they've been able to navigate, the volatility over the year, deal with the uncertainties in these types of asset classes, and still perform much better than their indices, I think is just really nice to see. It's all just really nice to see. If you just want to turn back one page to page 13, we've sort of moved more money, I'd say, out of the short-term bond ladder when bonds have been maturing. We're putting a little bit more into the intermediate, but still being overweight short-term has helped. Even in the last month, quarter, fiscal year, basically you keep going back and back, you'll see the, intermediate maturity is about 200 basis points less than the short term. And so we're staying, in the short-term bonds. If you want to turn to page, 19, 20, that'll kind of give you a sense of where we are. So 19 gives you just sort of the maturity schedule. You can see basically, a bulk of them are certainly less than 3 years or 4 years. Maximum is out to 7. So our duration is actually, if you could go to page 21, our duration is at 2.82. Okay, it was below 2 basically about a year ago. So we've increased duration by basically 50%. And our yield to maturity is 5.28. So still getting a very good return for the bonds, even with all the volatility going on with rates. And those are things I wanted to highlight. So any other comments, thoughts?
Comments, anyone?
I'd say to just, some of the questions we're getting are, what do you expect from the administration? What are the, asset classes or things that are gonna do well? One of the charts on the market perspectives is kind of interesting because it shows the asset classes that did well after Trump was elected in November and won the election. Bitcoin is by far the best asset class. It's like, it's wild. And if you put, the Trump coin on there or whatever it is that he did, I'm sure that would look pretty good too. Small caps are probably gonna do well. Okay, he's gonna have a more protectionist agenda. And small caps have less exposure to international markets, right? So that's one of the reasons we've had a small cap allocation. We added that mid cap should do well as well in that sort of scenario. And financials have done well. And there's thoughts of deregulation in the financial industry, which could be a short-term positive, a long-term, let's see, because sometimes when we deregulate the financial industry, it ends up not looking so great. But the part of it too, the financials done well, is the yield curve is finally starting to normalize, which means longer term rates are paying higher than shorter term rates. And in that scenario, then for lending, okay, it doesn't have to be mortgages, it can be lending to corporations or other banks or whatever it may be for liquidity. You're borrowing at rates that are less than what you're receiving, right? So that's actually more profit. It's called net interest margin. More profit to the banks, which is very, very helpful for them. So financials have done well. Energy has been sort of mixed, I would say. A lot of people think that energy is going to be a good part of what he favor in his agenda. And I'd say he certainly is going to deregulate and allow more drilling. But what we saw in his prior administration was that actually all the things that he did in that actually didn't help at all. Oil actually ended up going down a lot, which is great for prices at the pump, but the corporations actually did not make any money, right? So that's a sort of, I'd say, a risk, right?
What about the energy needs for AI and all that kind of stuff? We keep reading about, that's booming so much and that's gonna be a positive, but I'm not sure what the answer is to it.
Yeah, so that has more to do with like electricity supply. And one of the weird things, I was at a dinner last night where a small cap manager was talking, and they said that HVAC companies are really going to be the big beneficiary because you need to cool these data centers. And they're building the data centers, and basically they have to put in these very complicated HVAC systems to make sure that it doesn't get too cold, doesn't overheat, monitors all the temperature for the computers in there and all that stuff. So that's going to be one of the big beneficiaries.
Does Mitsubishi make huge mini splits? Or anything? I mean, are they in that business?
Very
You know?
interesting.
I mean, what's happening is like a lot of private equity companies are actually going around and buying these sort of like mom and pop
Yeah.
HVAC companies and then rolling them up into like bigger entities.
Yeah.
You know, to me, oil's not the play, because they don't wanna drill more, because they want oil exactly where it is.
Mhm.
So
Yeah.
LNG terminals, which Biden stopped, President Biden said, we're not gonna build any more LNG terminals or new for
Yeah, liquid natural gas
export.
stuff, yeah.
That is gonna happen.
Yeah.
That is, there's going to be either new terminals built or more shipping built for that, or more LNG exported. That, everything I've read over the last year, that seems to be the play.
Another thing that might actually be a good area too is alternative energy, believe it or not. So Trump's policies are clearly like, he doesn't want green stuff and all those kind of things, right? But from the company standpoint, if they can't make enough money in regular oil, let's just say, like traditional, oil, because the prices aren't where they want them to be to drill and to ship and wherever, they might decide to put more money into solar and wind and water and things like that, because there's gonna be higher profit margins in those areas.
What about
And that's what happened last time he
They
was in
can lose more
office.
money in those areas. They can't.
Yeah, that's what happened though. Those stocks actually did better under Trump's administration, believe it or not, than traditional energy last time.
Wow.
It's like, wow. And then under Biden, they did terribly and traditional energy did well. So it's always kind of counterintuitive. So
It's like predicting a stock market, it's completely unpredictable.
Well, right now it is, because you just don't know what
You
is,
can do one thing one day and something.
what is actual agenda.
I mean, TikTok was gonna be banned now. He's like, no, it shouldn't be banned, because the vice president of China came to the inauguration, something.
We'll see.
All unpredictable.
But none of it is, just go back to portfolio, quality, income, lower valuation. That's where we want to be. So I feel like we're well positioned.
Actuarially, what's Becky, when are we seeing Becky next, or?
So I just sent her an email yesterday because I want to know what our ADC is. She promised it to me by tomorrow for the town and the fire. And once we get that, we can schedule her for typically, I just care about it for the budget at the moment, but either February or March.
Yeah.
So then we can kind of finish up our assumptions there for the IP. That has to do with the IPS as well.
Mhm.
They say, and I've heard this several times, AI could be a threat to actuaries.
And a lot of other businesses.
Yeah, but I've heard actuaries, like, that's just something AI can do.
Right, and accounting too.
Yeah.
Yeah, finance, maybe not well. No, but everybody has to change. No. We just have to approach it differently. You shouldn't be
Well,
afraid.
I went to a seminar through our insurance company, Kerma, 7-8 years ago. And they were talking about self-driving vehicles, and here they come, and it's gonna destroy the personal injury law industry, auto body shops, because there'll be less accidents. Auto insurance is gonna change a lot, because it'll be more product liability insurance, not less on the driver. And they're like, and the biggest employment industry in the United States is truck driving. And that could have the biggest change, with more drivers out of work. And the guy's like, this is gonna be a sea change for society and unemployment. And I'm like, the US economy for 200 years has changed, and new jobs get created as the economy changes. So I'm in the camp of, it's not a zero-sum game where just this has to end and those people will never have another job, So AI will change things, but hopefully there'll be new industries will be created and jobs will be needed.
That's what I think too.
Okay, anything else for Kevin at the moment? Okay, Leanne. let's jump
Okay.
into the-
So Kevin and I have co-authored, actually, this has been presented to you all before. Long time ago, our investment strategy and how we expect all of the different asset classes to work. We have a couple of recommendations in here. But first I want to read our policy to you on the investment objective. So the plan assets should be invested in accordance with sound investment practices that emphasize long-term investment fundamentals. The objectives of the plan are to maximize long-term returns consistent with prudent levels of risk. Investment returns are expected to provide adequate funds to sufficiently support designated needs and preserve or enhance the real value of the plan. So cash flows and that ultimate value of the plan. In establishing the investment objectives of the plan, the PBB has to take into account the time horizon for available investments, the nature of the plan's cash flows and liabilities, and other factors that affect the plan's risk tolerance as part of the asset allocation study. Accordingly, the investment objectives of the plan is growth and income. The investment objective is a balanced investment approach that is expected to achieve a positive rate of return over the long term that would contribute to the portfolio's income needs. Then on the other side, risk tolerance. Let's see. Given this relationship between risk and return, a fundamental step in determining the IPS for the plans is the determination of an appropriate risk tolerance. The PBB examines its willingness to take risk, and the plan's financial liability to take the risk is based on the long-term horizon and the financial strength. Basically, risk is the primary thing that we focus on, and whatever return we are able to generate from that risk is what we should generate. So there's been a conversation going on about, and they're kind of in opposite, maybe a little bit opposite of each other. Do we focus on the development of income and ultimate value of the plan, or what role does the benchmarks play and our inability to meet those benchmarks? You know, they're kind of like at odds somewhat with each other. So Kevin and I kind of went about this memo to explain some of these things, hopefully, so that we could come up with a final resolution and everybody feels comfortable with what it is that we're doing here. You know, how are we investing? First of all, I would never be looking at the 1 month and 3 month numbers. I would always be looking at the 5 and 7 year numbers. I think that's where we should concentrate because we are long-term investors, number one. Number two, all of these asset classes that we invest in aren't supposed to potentially aren't supposed to even equal the benchmarks, such as emerging markets, where we want to just be exposed to those areas, but we want to be at the higher end of quality in those types of investments. And I think we all agree that we want to be in a 60-40 portfolio. I don't know if everybody has taken the time to read through this thing, but we also, under investment objectives and performance benchmark, which is on page 2, have kind of, and maybe flowing into page 3, we've kind of listed some of these things that I'm talking about. Performance isn't tied to our primary objective. The portfolio is going to perform differently than individual benchmarks. Kevin just went over that, you know, with how much, you know, top 10 investments in the benchmark are affecting the benchmark. The portfolio is a spending portfolio. We talked a lot about how much we're earning and how important that is to paying our payroll. It's difficult, you know, and also when we take money out of the portfolio, it causes a problem, you know, somewhat to it, you know, that for that month specifically. Let's see what else. And again, the short-term horizon does not reflect the full market cycle. And obviously we want to be diversified. So all of those things have been taken into consideration with our asset allocation. But I feel when I hear all of these discussions, and I wish Paul was here today, you know, that, well, what's the use of having a benchmark if we're not gonna, you know, get close to it? And how do we reconcile the difference? Because I think that we are meeting our primary goal. Clearly, we are meeting our primary goal of having income, the portfolio's growing. You know, but what do we do about our conversation with the benchmark? And,
I do have a bunch of comments from Paul.
okay,
He had a
good.
bunch of
Well,
comments.
why don't
I'll give
we,
it-
why don't,
And we won't act on anything today, but I'll throw out his comments and
good idea.
we can have a discussion and then act on stuff hopefully next month.
I'm glad that you did speak with Paul because,
He gave me a whole long list
okay,
of.
you go, because, I'll continue and Kevin can continue afterwards.
So just sort of going, I'll go through Paul's, and again, this is what Paul did for a living, forever. And just run down through all of his comments here, and we can talk about them or whatever. One of the things right up front, he's wondering whether or not we should move our assumed rate of return from 6.75% down to 6.5.
Mm.
And we've been moving in that direction, and now might be a good time to continue to do that. And I guess I would agree with him on
Yeah, me
that,
too.
that we should look at that. Now's a good time to do that.
When the action, I think that will be, I think that will be more clear when the actuary comes in
Yeah.
and she takes a look at if they, you know, the future returns like Morgan Stanley and other houses like that.
Yeah.
Will project.
Yeah, and everything we
project
hear
that
and
forward.
stuff, I mean, I
Yeah.
think that makes sense. It'll go down a little bit rather than up or even the same.
Mhm.
So it makes some sense. He's happy with the large cap range, the change, the 29 to 34. The target and stuff like that.
Okay.
And that's one also that I'm happy with. The one that he would, this is probably the biggest one, I would say, the mid cap and the small cap, the developing markets and emerging market equities. He's suggesting that we flip those. Yeah,
Okay,
we've
so
got-
what would that mean?
We've got mid cap, small cap, 7, 9, 3, and 4. Developing market, 10, 13, 10, 13. Mid cap is small cap would be 10 and 13 and 10 and 13. And developing market and emerging markets would be lower. Again, and that, you know, with the drum I've been pounding about emerging markets and developing markets and stuff like that, and some of this, I hear what people are saying about emerging markets, but to some extent, what that's doing is just competing with the US. What we're trying to, what Trump's trying to do, and then all the action and all this kind of stuff, the emerging markets are gonna get hurt by that somewhat.
So we're gonna go from
Yeah.
20%, or according to Paul, I should say,
Yeah.
20% international down to 10% all in. Together. And then we would go from
20,
from 20%, I'm looking at the target number, 10%, 10%
yeah,
to 7 and 3.
Yeah.
So we'd go from 20% international to 10%, we'd be cutting it in half.
yeah,
And then obviously, going from 10% small and mid to
Up to
20%.
yeah.
With 34%, so we'd be 54% US equities. Correct?
Yep.
54% US and 10% international.
And then another comment on the mid cap and small cap, not so much on the memo here, but on the return. We saw that we have a new mid cap manager that's underperforming. Paul's comment is, why don't we just buy the index on mid cap? And I guess the comment would be.
So-
What you said, that they just started.
Well, I mean, yeah, we've only had them for basically 8 or 9 months.
Yeah.
Right, so that's one thing.
But that's one that.
And then second is, you know, historically, active managers in mid cap, small cap, and especially emerging markets have shown to produce alpha over the longer term. There's a lot more information to manage in those types of markets than there is in large cap. So,
Yeah, I think that's something we just want to keep
yeah.
an eye on what's going on there. But yeah, the biggest probably change is the flip flop from the 20 to 10 between international and emerging.
That one would have to be modeled, I don't know, you know, Kevin, do you have comments on that?
I mean, I don't disagree with increasing mid cap and small cap. I do disagree with decreasing international and emerging markets. So I think maybe there's a happy medium there if we're doing asset allocation. So
Or maybe not flip them completely 10 to
because
20,
we'll be overexposed to the
maybe go
US,
some.
which
That's
would
what
have
I
been
think
great the last 15 years,
instinctively.
but we just don't
Yeah.
know how
Yeah.
the future
Yeah,
is.
somewhere in between, moving in that direction.
Right.
We find out that,
So just so the committee knows, that would result in a more concentrated portfolio. All right, I just want everyone to be aware of that.
Maybe we
But I
could do what Paul says and then a lesser degree of what he says.
Yeah, like I think there's a happy medium.
Yeah,
between those
yeah.
two things.
Yeah.
So,
that's what he had on the equity, and then on the bonds side, investment grade and short term are the same. And it's wondering whether it should be intermediate and short term. Bonds.
Investment grade, short-term and
Well, he
intermediate.
said he feels investment grade and short term bonds are really the same thing,
Mhm.
and whether investment grade should be intermediate.
I think, just so I'm clear, I think, Kevin, our short-term, is that our ladder?
That's the latter, yeah.
That's the ladder. That's kind of
Okay.
important part of our strategy. I
Okay, so
think.
short term is the ladder, and that's what I didn't follow that exactly. He said ladder, build out, can we build out the ladder? And that's in the short term.
Yeah, that's in the short-term one, yeah.
Yeah.
So so maybe his recommendation is to reduce investment grade and increase the ladder. Is that what it maybe is?
Well, I think he's saying investment grade should be intermediate.
Oh,
The short term, the ladder should stay the same,
Okay.
short term. But the investment grade should be intermediate. And right now, the investment grade and the short term are basically the same thing. Should investment grade be a little more intermediate? I don't know what the
Is that
thoughts
true,
are on that.
the investment grade is Barclays Ag.
Yeah, the ag does have, short-term and long-term bonds, right? So, if we're gonna do intermediate maturity bonds, then we have to change the benchmark. That'd be the first thing I would say, to an intermediate maturity benchmark. And we have right now again, a short-term bond ladder, which the benchmark goes up to 5 years. So it's basically just saying that, anything less than 5 years can be classified as a quote unquote short-term bond. And anything over that is going to be classified as, in the investment grade bond category. So if we just make that intermediate maturity bonds, then we just have to just change the benchmark. I think that's the biggest thing.
But I think we're gonna shorten our duration, correct, if we do that overall? Overall, it shortens our duration. Is that what he wants to do, isn't it?
Well,
Well, our intermediate maturity bond manager does have.
that was a
short-term
question he had
bonds,
with the
too.
intermediate and short term, we're at 23% right now.
Mhm.
And his question was, what's the duration?
Okay, all right.
So he was questioning that. Too. So,
Well, for that one, I want to see what happens to our duration. Excuse me, to our duration.
and then the only other comment he had was on the high yield. His feeling is that should be characterized more like stocks, because it's risk equivalent to stocks. So just so we're aware of that. The high yield bonds are more like stocks.
That's why we have them in there.
Yeah.
They perform very similarly to stocks.
Yeah.
Not as much, but they have a lower risk.
We might mention that in the IPS too.
I think we do, yeah.
Yeah.
I think he's probably just mentioning.
Yeah, that's what he was doing. He just mentioned that. So we should just be aware of that. And that, those were all his comments. He supported the other changes that were already in here.
No, okay.
So again, the big thing is the dropping 6.75 down to 6.5 and then
Mhm.
spreading a little bit more to mid cap, small cap, and away from international and emerging markets.
Mhm. Okay. All right.
And I would support those two.
So good comments. I'd like to hear, maybe you take that back and, next month, maybe give us maybe some Morgan Stanley research, your opinion,
Yeah.
Morgan Stanley research
Yeah.
on that. I hear you when you're saying we're over, you don't want to be too exposed to one market either. And that's the reason you have international. In my 457, I think I had a lot of underperforming international. And it's been really good lately, and as I recall, right? I looked at it the other day, I was like, oh, turned into a pretty good account. So I'd like to hear more. I mean, and so I think, and I love Paul to death, and I respect all his opinions. Whenever you say that, you know there's a but, right? I think we need to, these are good inputs, but the fact that someone's done it for a living, I think can also be a little bit, we have to be a little bit careful about saying, okay, here's the expert on our 7-person commission. We should let that expert drive the commission. I think, you know, we have to be somewhat cautious about that and say that's really valuable input. Let's hear from our advisor.
Yeah.
That's, so, I mean, not that we won't do it, but I think we need to hear a little bit more about it.
No, I agree, and that's why I wanted to throw his thoughts out today.
Yeah.
Let us think about it, let you think about it, come back next month, and we'll talk about it more then, and maybe take action next month, or.
Well, I also want to make a comment too, that even if this comes back and, you know, Kevin says, oh, that's a great, that works out fine, or here's another option that works out a little bit better. We're still gonna underperform the benchmark, I think, no matter what we do with this. And I just, you know, because of the investments that we have, that they're lower risk, that they're diversified. So we're still, no matter what we do here, it's still gonna be at odds. And that's kind of the point that I wanted to make.
I would agree that will happen, but hopefully we're gonna underperform a little bit less, because moving in the right direction. And that's where I would push the emerging markets and international. I mean, I just think with, you know, given the current administration's, the whole focus is US, and that's gotta hurt international.
Yeah,
But our
but let's say
benchmark,
Trump strikes a deal all of a sudden, like I'm threatening you with tariffs, and then all of a sudden there's a deal made. And with Mexico, Canada, China, and Congo, which you brought up the other day, you know, all of a sudden, international might rally, you know, and that, listen, he's our president. I don't necessarily think there's a lot of strategy necessarily with him. Some people think there is. I just think it's so unpredictable.
Oh, I agree.
That I think, like Kevin said, in the first term, alternative energy did really well. And now people are saying, Joe baby Joe, oil's gonna go to 35. Exxon ain't gonna allow that to happen. Just not. So.
and I'm still gonna make the benchmark discussion, because our benchmark that we have is customized to what our allocations are. So whatever we change them to, our benchmark is going to change to that. We're still gonna underperform. And we're gonna underperform because we take on less risk. And we don't really care what everybody in the world does. We have to invest in it anyway. And, you know, it's gonna be what it's gonna be. The managers that we choose are less risk averse than if we were to go into the benchmark. And that is what we have to be comfortable with, that we are choosing active managers versus the benchmark. And there's many times that they underperform. And that's because we want managers that purchase stocks that have higher dividends, for example, to add to our cash flow. So I just, you know, I kind of wanted to really get into that.
And that's
So
the
that
two
we're
things you said are a
comfortable
little bit.
I want everybody to be comfortable with that. So,
Sorry, I just want to say two things. One is, certainly can run the asset allocation study, so I can show you what Paul's recommendations would be, maybe some sort of like, you know, happy medium in between those two, so we can kind of evaluate that. But I also want to point out that the reason we came to this allocation in the first place was the original asset allocation study we did maybe 7-ish years ago, okay? And the committee came to a decision that this was the level of risk that they were comfortable with, right? So I want to be just, you know, historical perspective. This isn't like we just, decided that emerging markets international were gonna be this weight because we felt like they were gonna be a good asset class. It was actually because the diversification and the lower volatility that it brought in the portfolio made the committee comfortable with the risk that they were taking. Okay, so, just want to talk about that.
And just a general comment from my perspective, again, I respect Paul's opinion very highly, but I really don't think the committee should be messing with
I
the
can't hear you.
details,
Thank you.
messing with the details of the portfolio that much. I really don't. That's why we have, Morgan Stanley.
Well, and that's why we have the IPS to sort of lay out, and we have the ranges. And that's why they can move them within the range and even outside of the range to some extent. And I think, with the emerging markets international, I've been beating this drum for a long time. I'd like to see that come down just a little bit. I mean, I think we still need to stay in it. I agree with that. And you just stay diversified, but I'd like to see it come back a little bit more. So I'm not suggesting flip them like Paul is, but somewhere in between would make me happy. And then again, they're working within those ranges and stuff. And the IPS that we put together 7 or 8 years ago, whatever it was, has served us well. You can look at it and say, yeah, we didn't hit the benchmarks in it, but there's reasons for that.
Exactly.
And yet, the overall, you can look at it and as a report, we got a good, solid, well-funded plan. And that's what we want to keep.
I just point out too, on the last page here, second last page, current performance. One of the things that Leanne mentioned was the 5 to 7 year horizon, and when we look at the 5, 7, and 10 year horizon, we're actually exceeding the actuarial assumed rate of return, right, which is really important because that means that, you don't have to put more money into the mention in terms of the town, right? And then when we look at the very last kind of paragraph there, you can see that the cash generation from the portfolio, just in dividends interest, not in total returns, just in dividends interest, has covered the liability payments for the last 3 and 5 years, more so. So that just means that regardless of whether the market's up, down, sideways, whatever, we know that there's enough cash. That's just from the portfolio. That's not from the town's contribution or anything like that. That's just from the portfolio's dividend interest. And that's getting better as we've discussed, right? So.
And that's as Leanne says, we shouldn't look at the 3 to 6 months.
Yeah.
That's
We
what we
gotta
want.
look at it longer term because we're long-term investors and that's that's what we're here for. That's good information.
Yeah, I thought the document was excellent.
Yeah.
Yeah.
Yeah, and again.
AI couldn't have done that.
Damn
Where do you think it came from?
You and Kevin, it didn't come
from AI.
I use it all the time. It's great.
Again, I think what we're doing is taking a hard look at it and saying we need to make tweaks to it. And that's what we should be doing.
That's reasonable.
And we'll take your advice on what makes sense.
Sounds good.
Okay, that was what Paul had. Other questions, other comments on that? Leanne, anything else?
Nope, I mentioned that we're gonna talk about the actuary report and that's one of the comment.
I would say probably if it should come in March would be
Better. Okay.
better if we can maybe finalize.
Right. I
In
think so
February,
too. Okay.
and in March we can,
I'll ask her.
or we can have the input from her on just going from 6.75 to 6.5 for February. If that works. The key there is make note that our February meeting, we moved it earlier in the year, we set these up, it's the third Thursday rather than the 4th,
What date is that?
it's February 20th. Yours truly will be with Mickey Mouse on the 27th.
So you're right, yeah. I think I'm not going to make that one.
Okay. So, any new business? No old business, no new business?
Daryl, do we want to have Becky and Kevin just spend a minute on what's happening here today?
Sure. What is
Giving us an
happening?
update.
So we, a couple times a year, we try to provide educational services for all the participants in the defined contribution plans. And so today is the day. We've actually, for the first time, brought in coffee and tea and some other refreshments. We're gonna be hosting about a 30-minute conversation, both in person here at 10:15, and also have a Zoom link. So every participant, all 117 participants, both in the 401A and the 457, got a notice, not only from the town, thank you, Janet and team, but then also from our emails about this event, and a Zoom link was sent out. And yeah, I mean, we're gonna cover a couple different topics, maybe a little bit about the market, a little bit about the power of financial planning, which we do offer as a service to every single participant who wishes to do one. And then factors of success when you're thinking about saving for retirement. And then also, I mean, first and foremost is just that we are there for them. There is no cost to them for us to come here and give them advice about whatever they'd like to talk about. So we do have meetings today. It's actually very interesting in terms of demographics. Some participants are in their 30s, some are in their 40s and 50s, and some are pretty close to 60. So interesting.
That sounds like fun.
Do we show them numbers, like here's what the compounding can be if you start putting stuff away at age 30 and all that kind of stuff?
So
That's
we
powerful.
have a whole retirement division, obviously, at Morgan Stanley that looks at those who are saving for retirement and then those who are actually spending in retirement. There's like two different decks that we could look at. And the compounding and the factors of success that are actually in the participants' control. Because I think a lot of people just think, oh, it's the market, they're gonna do whatever the market does. And again, over shorter periods of time is correct, but longer periods of time, obviously, the more you put in and the earlier that you start doing it, the higher chance of success you're gonna have. Right? And that's actually in your control. That has nothing to do with the market, right? So I think it's eye-opening for people when they see that. But yes, the answer is yes.
That's good. Hopefully we have some decent turnout for that. You've had that in the past, right? We had a reasonably good turnout for people.
Yeah, and I think, for all 117 or so people, they're all at different life stages and everything in the market's doing different things. And so you'll see sometimes when people are really concerned about the market and they're worried about it. And then other times they're really concerned about where I am on my own individual path. And so for us, that's almost a more important conversation, and that will hit people at different times in their lives.
Right.
But I think, and then the ongoing, we've been at this for 3 years now, I believe. So I think just the ongoing conversation also helps. They know who we are, they know how, we've had some really good, Janet is a tremendous partner. So thank you, Janet, for making sure that we are aligned, that participants that come to her, she directs to us, and if we hear things that we have questions about, we can go to Janet. So it's a wonderful partnership.
The Board of Ed seems to have a lot more turnover, if you will, a lot of new people. Are we getting them to come to this stuff? I wonder.
Well, they all received the email directly from Empower.
Yeah.
So they were all notified.
Okay, good.
Well, we have the ability too to see new hires and work with Janet to target those people that maybe aren't, utilizing the match right now
Okay.
and reach out to them just directly. And say,
Yeah, we do that every year.
Yeah.
And they really come from different pockets, I don't want to speak specifically, but, there are people who have the pension and they feel like that's gonna, between what they're getting from the pension and maybe what they have outside of Empower Morgan Stanley, they're just fine. They don't need a 457 contribution. That's their individual decision. There's some people, especially in the Board of Ed, that kind of go in over 20 hours, 23 hours of service, and then go out, and then go in and then go out. And so they're able to contribute at some points, and then they aren't able to contribute. So there's really, again, a lot of individual kind of situations that kind of build into the absolute statistics.
In retrospect, perhaps I should have thought of this prior to this meeting, because this would have been, I think, a good meeting. Would it be of any value for me to invite my, my counterpart at the Board of Ed to come and attend this meeting? So she's relatively new. I think she's been with the Board of Ed now for about 5 or 6 months. And, I've discussed this with her and,
I guess that would be my big question. Does she understand this and does she know the message? Is she's getting out the same message that you are? I think.
I can't say for sure what exactly she's doing.
You
And
discussed
what
all
she's,
with her.
I did go over to the Board of Ed, I think it was in October, maybe early November, and showed her the flyers and kind of discussed with her what I do. Not that I advise, but I educate as much as I can.
Yeah, you talked with her?
Yes.
That's good.
Yeah, there is, because we've been on it for, again, around 3 years or so. There are learning curves to all the data that the town has and inputting it into Empower. And so sometimes what we see in Empower is slightly different than what's here at the town. And so, but we've worked through those kinks and we've, streamlined it. So sometimes the reporting on our end on Empower isn't 100% accurate because we actually don't see the town's records. It's whatever the town uploads, and sometimes there's glitches with that, and some things we realize with telephone numbers, put in the dashes, things like that there can. But we've been working on them over in time, and the data from what we can see keeps getting better and better, and the communication keeps getting better and better.
Yeah, I think from our responsibility and what we need to do is just get the message out there. It sounds like you're doing a pretty good job of that.
I just had a quick question. I know one of the duties of the commission is to look at the costs and expenses of everything. And I'm not sure, do we have a place we can look and kind of see what all those are, like for last fiscal year? You probably
I may
did.
have sent that, or I was going to. Didn't I do that? So what we have is at the end of the year, when we're preparing our financials for the auditors to come in, we prepare these schedules that show what we paid out in benefits, what our investment advisory fees were, what we paid to the actuaries, all of that stuff. So I'll do it next month.
Just share it with
I'll
us.
just send it out again. I thought I could have forgotten. I
Do
actually
you have
can't
that as
remember.
far as the annual report submission?
Yeah, I give this board just that piece of it for the pension plan. So I'll resubmit that.
All right, thank
If
you.
I haven't done so already.
Okay, anything else? All for